Hello and welcome to our weekly review of the crypto market. The past 7 days were remarkable for both Bitcoin and Ethereum. Also, more shocking details surfaced during the investigation into the collapse of FTX. In today's video, we will also talk about the exchange rates of the main digital assets of the past 7 days. Clearly, the US inflation report was in the focus this week. These figures are key to the Federal Reserve's stance on monetary policy. Yesterday's slowdown in consumer prices boosted risk assets and sent the greenback into a tailspin. The US dollar index tumbled to the area of 100.5. What does a decrease in inflationary pressure mean? It means that the US Federal Reserve may now pause hiking rates and assess the effectiveness of the previous increases. However, investors should keep in mind the following facts. First, the regulator has repeatedly stressed it will not stop hiking rates until they reach the 2% target. Second, the US jobs market is still quite strong, which implies that the central bank does not have to worry about a recession for now. Third, the Federal Reserve rigorously monitors the core inflation rate, which, by the way, accelerated to 5.6% in March from 5.5% in February. In fact, the greenback extended losses and crypto started to grow a few hours after the release of the US inflation report. At the same time, the Cleveland Fed released the median CPI, which dropped to 0.4% from 0.6%. About 70% of the market had bet on a 0.25 rate hike in May before inflation data came. Now, even the most convinced hawks believe a pause will follow and stock indices will go higher along with digital assets. These expectations have provided support for crypto in recent weeks. In fact, Bitcoin bulls have been so optimistic that pushed Bitcoin above the resistance level of $30,000 twice. The breakouts occurred on April 11th and April 12th, and the price reached 30,453 and 30,406 respectively. Over the past 7 days, Bitcoin has gained over 5%. On April 12th, it traded in the range of 29,851, 30,473. Support is now seen at the level 29,200 and 28,800, while a resistance stands near psychological levels of 30,500, 31,500 and 32,000 per coin. Although Bitcoin has increased since the beginning of the week, it closed down by 0.5% yesterday. At the same time, Ethereum, the world's second cryptocurrency by market capitalization, tumbled by over 2.5% and traded below the mark of $1,900 per coin ahead of the Shapella upgrade. The Shapella upgrade technically combines two major modifications, Shanghai and Capella. Shanghai will bring changes to the execution layer and Capella to the consensus layer. From now on, Ethereum holders can withdraw their staked coins and stake additional amounts of Ethereum. One of the consequences could be mass adoption of staking and that Ethereum will remain the largest proof-of-stake network in terms of stake capitalization. In terms of price, Ethereum will unlikely be bullish in the near term. On the contrary, experts predict mass withdrawals of Ethereum coins for selling. Driven by these expectations, Ether entered a bearish zone, plummeting to the support level of 1,830 on Sunday from the high of $1,911. Volatility then surged and the price managed to test resistance around 1,900 twice on Tuesday and Wednesday. Ahead of the upgrade, Ethereum traded at 1,913. Right after the hard fork, the Ethereum price was at 1,915. In fact, the Ethereum network can now process more transactions per second and offers better security and efficiency of smart contracts. Undoubtedly, Ethereum 2.0 marks a new era that hopefully turns the token into a viable long-term investment. While Bitcoin and Ethereum are scoring gains, XRP holders seem to have lost all hope and are bracing for the worst. The thing is that the Securities and Exchange Commission has filed a letter of supplemental authority in support of its lawsuit against Ripple. The company and its CEOs Brad Garlinghouse and Chris Larsen are accused of violating U.S. law by raising more than $1.3 billion after selling XRP as unregistered securities. The battle of the Commission with Ripple has been going on for more than 2 years now. The problem is that neither the US nor other countries have developed a proper regulatory framework for the crypto market yet. So the parties are trying to find additional legal precedents in their favor. In early March, Ripple lawyers said that the Commission did not provide a fair notice of violation in relation to XRP and other digital assets. Back then, the XRP price skyrocketed on expectations of Ripple's imminent victory. Yesterday, however, the regulator sent an additional letter to the court pointing to the 2019 court decision. Back then, the Securities and Exchange Commission filed a complaint against Commonwealth Equity Services LLC and its CEO John Rooney, alleging the firm violated federal securities laws. The regulator won the case. This new letter, according to lawyers, may change everything. In response, XRP plummeted, losing over 2% yesterday and more than 30% since early March. Currently, it trades at $0.5. Interestingly, despite attempts to regulate the cryptocurrency, the US is considering whether to adopt a digital version of the dollar regulated by the Federal Reserve. However, unlike crypto, CBDCs would be less anonymous than fiat, meaning they give federal officials full control of their holders. While the US government is figuring out how to fill the regulatory gaps, the Securities and Exchange Commission has increased its enforcement in those areas where the government has discovered those gaps for digital assets. While Treasury Secretary Janet Yellen calls on the government to introduce a regulatory framework for the crypto industry, the Commission Chairman Gary Gensler said there was no need for new laws to regulate the crypto market. Perhaps the regulator fears that the new regulatory framework could seriously damage the market of traditional securities. This week, we received more updates on the bankruptcy of FTX and its subsidiaries. Recently, an interim report of the investigation of the former crypto exchange regulators was released. It reflects a truly shocking picture of the carelessness and mismanagement of Sam Bankman-Fried's crypto empire. John Ray, who was named CEO of FTX after Bankman-Fried stepped down, said that FTX was pure chaos and the exchange was in the hands of a small group of grossly unexperienced, non-sophisticated individuals. The report reads that the company kept almost all of its crypto assets in the hot wallets, meaning they were connected to the internet and could be hacked anytime. In addition, private keys for various wallets, including one with more than $100 million, were stored in plain text and were easily accessible. The company uploaded some keys to additional digital assets amounting to billions of dollars to Amazon Web Services, a password manager. And it was available to many employees who could transfer assets to their discretion. It turned out Alameda Research, the investment firm founded by Bankman-Fried and Wang before FTX, had no idea how much money they had. Sam Bankman-Fried used Alameda and his personal piggy bank, where tens of millions of dollars flowed into his bank account between 2021 and 2022. However, Alameda continued to use the money it borrowed from FTX in exchange for promissory notes. Sometimes they did not use them at all. The report also notes that record-keeping at the crypto exchange was so lax that Ray was unable to compile a complete list of FTX employees. In addition, Sam's crypto empire included over 100 companies, and there was no record of how they were related or who owned them. Employees used Signal and Telegram with the auto-delete timer to send corporate messages. This fact makes the investigation even harder. Due to the mismanagement, some funds appear during the investigation, but there is also a chance that some keys have already been lost for good and crypto assets stored in those wallets can be permanently frozen. This is where our weekly review of the crypto market is coming to an end. Have a profitable week. Goodbye.